I will introduce our first speaker. His name is Edward J. Modla. He is from OCC, a former market maker who is now an OIC instructor. His session title is called Options, Core Concepts, and Pricing. So without further ado, let us welcome Edward.
Thank you very much, Richard. And as I start to share my screen, just a little bit about my background. I started in the industry back in 1997 as an options market maker on the trading floors in Chicago and New York. But for the past 7 years, been working with OCC, specifically the Options Industry Council, providing options education, equity options specifically to all market participants. Anyone that wants to listen, very excited to be here today for this entire event, starting with this core concepts presentation that I put together, really basic level. First, our disclaimer: options are a rather complex tool that need to be well understood before using in a live account. And here's what the outline looks like for the next 45 minutes or so. I'll start by defining options in their most basic form, rights and obligations, weaving in some simple strategies, and we'll discuss what those look like. Then we'll get into a bit about options pricing, how that works, some of the variables that are involved with the pricing of an options contract, and then what you can expect to see in your account. Whether you're a new trader to options, you will certainly want to know what happens to your various account balances, or even if you've been trading options. I'm often surprised investors mostly are looking at their net balance. They're not checking what happens with their cash and their positions. So I'll walk through a little exercise there to outline what happens when you buy or sell an options contract. Before I define what options are, let's take just a step back and remind ourselves, why are we using options in the first place? Richard touched on these things in his opening remarks. Options offer ways to capitalize on various market directions. No matter what your thesis is, bullish, bearish, or neutral, there's an option strategy for you. But in addition to that, you can actually accomplish risk reduction and potentially enhanced returns using options contracts. You can, of course, use options irresponsibly if you don't understand them. That's what makes education so important. But if you do understand the strategies, understand how the options product works, you can actually construct positions in your portfolio that are more conservative than just buying or selling shares of stock. Income generation refers to selling options and the advantages that it gives to the investor to do so. Stock acquisition is a specific strategy you can employ. And of course, leverage, referring to buying options for a little cost and controlling a larger amount of shares. We will be looking through simple strategies that run the gamut here from all of these different market objectives for why you would use options. At the end of the day, it's about flexibility, being able to interpret the market, evaluate the market in a certain way, and having options in your toolbox to implement a position in your portfolio that is precisely tailored to match what your market outlook is. So now let's define an option. While you have stock, shares of stock that trade on their own exchanges, separately from that, there are options exchanges where contracts are traded. Buyers of options are paying cash upfront out of their account and receive rights to buy or sell an underlying asset. That means to execute a transaction in shares of stock. Whether they have the right to buy or sell depends on what type of contract they have purchased. They will also have the right to execute a transaction at a specified price and up until a defined expiration date. The seller of an options contract is paid cash upfront, non-refundable, into their account, and has taken on the obligation to execute the opposite transaction in shares of stock that the buyer has purchased the right to. Buyers have rights, sellers have obligations. And within the contract, that specified price, otherwise known as strike price or exercise price, you'll hear me use those terms today, that price and the expiration date go a long way towards determining what's this contract going to cost in the first place. So now let's look a little bit deeper. As I said, the buyers and sellers have right to execute a transaction, whether it's a purchase or sale of shares, depends on what type of options contract was traded. There are two types of contracts. First, let's look at call options, and then we'll look at the second type of option, which is put options. First, starting with calls. An equity call buyer has paid cash up front. It's a debit out of their account and now owns the right to buy shares of stock. The standard contract provides the right to buy 100 shares of stock. This investor is bullish on the underlying shares. If they own the right to buy stock at a fixed price, then the shares moving higher should influence the value of their option in their favor. This investor needs that stock movement to occur to a significant extent in effort to overcome the natural decay of an options contract. Options have this characteristic where they naturally decay from one passing day to the next. That's because part of the value of an option accounts for the possibility of stock price movements as you move towards expiration. So in between today and expiration, that potential change in stock price, the potential change in value is going to influence the option premium. And as each day passes and ticks lower, that value naturally decays. This call buyer needs their stock movement in their favor, specifically bullish to the upside. They need it to occur within a time frame consistent with their expiration date and to a large enough extent to overcome that decay. It's not easy to make money buying calls. We'll look at it more in just a second. On the flip side, you have the equity call seller. This investor is going to be paid money, paid cash to sell their option. That cash is a credit to their account immediately. And in exchange for that payment has taken on the obligation to sell shares of stock. And again, that's 100 shares of stock. This investor likely already owns the shares. And this is going to be within perhaps the most popular option strategy there is, which is the covered call strategy. I'm not going to get into that here because I've got it coming up in a couple of slides. Before I go into this, I just wanted to remind people, I do see some Q&A questions coming in, which is great. I'm going to set aside some time to answer Q&A today. Use that Q&A window. Feel free, don't be shy, send questions in, and we'll take some live at the end of the presentation, and I'll also stick around and answer them by typing out answers to you for the ones I can't get to. So now getting back to call buying. Here we have an example with a stock at $140 a share, and the comparison to long stock for call buying is to either buy 100 shares of stock or to buy a call option. Now, if you bought stock, 100 shares, it's going to cost you $14,000. And now you've got this nice clean break-even point at 140, and you can hold the stock for as long as you want. An alternative bullish trade is to buy a call option. In our example, buying the 140 strike call. You can choose whatever strike you want. We're choosing 140 in our example and paying $3.60 for the option. Remember, the option calls for the purchase or sale of 100 shares. It is quoted on a per share basis. So this is $360 total dollars. That's your expense. And if the option expires without value, that's the most you can lose. $360 is a lot less than $14,000. However, what makes call buying difficult to be profitable on a consistent basis is you need the movement of the stock to occur in your favor in a timely fashion and to an extent great enough to overcome that natural decay. Now, these graphs we look at, we're going to see several of them today, are going to be drawn with the expectation that we've reached expiration. And that's because prior to expiration, there's an element to an option's value that accounts for time. Discuss that a little bit. With a week or 2 weeks or 3 weeks left until expiration, you don't know for certain what the market is going to value that time as. So it's uncertain. It's an imperfect science to try and value an options contract with a certain amount of time left until expiration. Once you've reached expiration, time value is 0. There's no time left. You can clearly value an option based on a hypothetical stock price. At 145, this option would be worth $5. The right to buy stock at 140 with the stock at 145 is worth $5, assuming there's no time value. Now, if you wanted to estimate prior to expiration, what might this option be worth? Say you want to forecast the stock going from 140 up to 143 within the next 2 weeks, with 2 weeks to go left until expiration, you can estimate that value using, again, what Richard outlined, those tools in the beginning that TMX offers, the options calculator. Put in your theoretical future stock price, the days to expiration that you're trying to forecast out to. You will need to fill in the rest of the variables and then calculate a theoretical options price to estimate what it might be worth in the future given a stock price. Those other variables, we'll talk about those as well in a little bit. Flipping to the covered call, a very popular strategy. Most investors, whether you're new to trading options or you're well-seasoned, covered calls, very popular. And it has two components to it: owning stock and selling a call option. Sometimes investors will execute these two pieces simultaneously. If you do, that is commonly referred to as the buy right strategy. Oftentimes, this is not executed simultaneously. There's an overlay, owning shares at one point, and then at some point later in time, selling the call options. In our example, let's say you bought stock at 75, you were bullish, you thought shares were going higher, but they haven't. They've stayed at 75, they're consolidating, and you're losing your confidence in that bullish outlook. You could scale down your shares. There's other things you can do, but one choice is to sell a call contract, get paid $180, and willingly take on the obligation to sell 100 shares that you own at 80. The obligation to sell 100 shares at 80 is covered, that's where the name comes from, covered by the shares that you own. And what you accomplish by doing this, as compared to long stock, is you reduce your cost, that reduces your risk, that improves the likelihood of being profitable on the trade. And you can see at all of these levels, this intersection here, this is going to be $81.80. That's where these lines intersect. See if you can figure that out. At 81.80 and below, the covered call actually outperforms being long stock. And this is what's meant by income generation, selling options, risk reduction, giving you a greater chance of being profitable. What you give up in exchange for all of that is this upside potential. This upside potential. You're obligated to sell stock at 80. If the stock were to rally all the way up to 90, you can't capitalize on that entire move. Now, a few things to say about stock moving up. And a little bit might be geared towards investors who've used this strategy, who might already be familiar with it. The stock does approach 80 and you're starting to become more bullish. You can be proactive. You can go in and close the option, buy to close the 80 strike call, removing yourself of that obligation and going back to just being long stock. You can do that. Of course, you'd want to make sure your bullish outlook was confirmed. You'll also want to check to see, what do I have to pay to get this 80 call back, and then evaluate it from there. And the last comment I'll make with respect to the stock going up, let's say the stock does go to 90 and you've got a couple of weeks left until expiration. Some investors might think, well, I'll just go ahead and accept assignment. I'll just wait for expiration. I'll take assignment. I'll sell my shares at the 80 level I'm comfortable with and move on. Well, you'll probably want to track what this value is. If there's a week or two until expiration and you can already see that you're close to your maximum gain, which means the stock's above your strike, and the further comment is the call option has no more time value. If you've reached that point, then this position has all risk and no more reward. You can't make any more, but you could lose if the market were to crash. If you find yourself in that position, that's usually a good time to think about unwinding, closing the position, moving your capital somewhere else when there's all risk and no reward. Let's flip over now. We talked about call options from the buy side and the sell side. Let's do the same thing for put options. An equity put buyer, it starts the same way as calls. They pay cash up front. That's a debit out of their account, and they have purchase rights. But put options have the opposite stock transaction. They have the right to sell shares of stock at a specified price, and they own this right for a certain length of time. Just the opposite of what call buyers have the right to buy shares, put buyers have the right to sell shares. Two common motivations to purchase puts. One is speculating on a downside move. If you believe the stock is going to sell off to the downside and you're not an investor who would short stock, then options provide an opportunity to capitalize and profit on that bearish move. So speculating, we'll take a look at that on the risk profile. And also to buy protection. If you already own shares, you're bullish, you think shares are going higher, but you want to buy the right to sell stock at a certain level below their current trading price to protect the position in case something bad happens. You have the right to get out. This is very similar to buying insurance on your position. An equity put seller has been paid cash upfront, cash credit into their account, and has taken on the obligation to buy shares of stock at a certain price up till a certain length of time, specifically the expiration date. This investor likely wants shares or often wants the shares, just not at their current level. So they're going to sell an option, bring in some cash, bring in a cash credit while they're waiting for the share price to consolidate or drop a little bit more. And if that doesn't happen, they have a small profit. This is the cash secured put, which we'll get to in just a minute. So back to put buying, speculating on the downside. We have the stock at 200. Most investors are not shorting stock. If you are strongly bearish, the options market provides an opportunity. In this case, to buy, we'll say a 200 strike put option and pay $4 to do so. Your maximum loss is 400. If the stock were to rally, the right to sell shares at 200 when the stock is above that level, providing a higher level to be sold, that option's not worth anything. So you risk 200, but if the shares were to collapse to the downside, you have profit potential here. If the shares specifically were below this break-even point at expiration, then you're sitting in a profitable position. But most put buyers who are speculating are not intending to hold until expiration. Most likely, you're looking for the move lower to happen quickly. And rather than wait till expiration, you'll watch the option premium and you will track it with a target level. I want to sell this option at $6 or $7 or $8 or $10 or whatever you want to sell it at. You will target that level and sell to close before expiration, rather than having to deal with expiration day, and certainly rather than having to deal with exercising the option and going short stock. So put buying, speculating, mostly looking for that move quickly so you can profit off of purchasing the option lower and selling it higher prior to expiration. Protective put, this gets a little involved, so I'll just gloss over it. This example of protecting a position, being long stock at 120, you're bullish on the shares, but you're thinking, boy, if something bad happens, this stock could really collapse. You could use a stop loss order. Stop loss orders are perfectly reasonable, although they don't provide protection during off-market hours, evenings, weekends, holidays. You don't have that stop loss working for you. You could scale down the shares, or another alternative is to buy a put option, very similar to buying insurance. You pay a premium up front. In this case, it's $200, and you have a deductible. This is the difference between today's level and where you own the right to sell shares. If the stock were to drop from 120 down to 100, your protection is not there. It's like a deductible of an insurance policy, how much you go out of pocket before the protection kicks in. But if the stock were to drift all the way down, doesn't matter how low, 90, 80, 70, could keep going lower, you own the right to sell your shares at 100. So here's how it looks. Long stock at 120. When you buy a protective put, you're paying money, so you have an added cost, higher break-even point, underperformance if you don't need the protection. But here's what you're looking for: under 100, you have maximized your loss for long stock would continue to move lower. I think a lot of investors use protective puts to help them with the psychology of getting out of a trade when they should, when they know they need to. It's often the case that I would say the hardest trade to make psychologically is closing out a losing trade. Investors seem to be a sort of a natural tendency to want a trade to come back, to look for break even, to try and at least make some money out of it. I've been there before myself many times, staring at a losing trade and watching it get worse and worse and worse, and realizing you should get out. That's a lesson we all have to learn when we trade the markets. The protective put kind of forces your hand a little bit. You pay for that, but you're actually paying to force yourself into the discipline of getting out should something really bad happen. You know you got to get out of your trade. And now with respect to selling puts, this is rather simple. The cash secured put, remember what it means to sell a put. It means we are getting paid and are now taking on the obligation to buy stock. And in this case, we're comfortable with that. Stock's at 146, and we think that's just too high. The stock's got to drift back a little bit. So we're looking for a pullback into the 140 area, maybe high 130s. Instead of just watching the market and doing nothing, we could sell a 140 strike put option, get paid $200 into our account. And if the stock were to drop down, we have a cost basis here of 138. Break even at expiration, really is where might we have to buy stock? Our cost on the shares minus what we were paid up front, that $2 premium we were paid. So we might have to purchase shares here, and we'd have a cost basis of 138. If the stock doesn't go anywhere, it stays where it is, it stays above 140, it rallies, at least we have this small consolation prize of having been paid $200, and that would be our profit rather than having just watched the share price. Now, with respect to a key difference here, a lot of investors might think, well, this is just like working a limit order to buy shares at 140, but getting paid for that limit order. And there are some similarities, and that's a valid approach, mindset to have. I'll point out one key difference. If you are working a limit order at 140 and the shares drop to that level, you're going to get filled. You're going to get your stock where you want it. And if the shares rally, you will capitalize and benefit from that. If you sell the put option instead, you are likely not going to be assigned or have to buy stock unless the shares are below 140 at expiration. Early assignment is likely not to occur with put options. This means you run the risk, if you consider it a risk, of the stock dropping down to your level, not being assigned prior to expiration, finding support and bouncing sharply above before you ever get the shares. Now, you'd still have this $200 profit, but you would have never gotten the shares that you intended to get at your target price. That's one key difference between limit order and put option. A workaround, if you saw that happening and you were concerned about it, similar to covered call position management that I mentioned, you could buy to close this put option, get rid of it, take it out of your account, maybe purchase it for close to where you sold it, maybe have to pay up, but close the option and proactively buy the shares. That's a position management technique that you could choose to employ. And now having looked at those two types of options, calls and puts from both the buy and sell side, this is just a summary slide to visualize in a more succinct manner calls and puts from the buyer and the seller's perspective, the rights that they have and the obligations they have. With terminology, I often get this confusion with investors, long and short. We're used to hearing the term long, meaning you're bullish and you think prices are going higher, and when you're short, you're bearish, prices are going lower. In the options space, there's actually a second definition. Long just means you're the holder. You bought the option and you're the holder of the option. It has nothing to do with market direction. You're long a call, you're long a put, means you bought it. Not market direction at all. And short means you have sold the option. You've sold it and you've taken on obligations. Again, that dual definition sometimes trips people up, so I wanted to point that out. But here's just a nice summary of the rights and obligations associated with buying and selling calls and puts. Now, I do want to get to option premium, and then we'll take some questions. But before I do premium, I want to make sure we're on the same page and we understand what moneyness is. So I'll quickly define the moneyness of options. Every options contract across the spectrum of strike prices can be characterized by one of three, we'll say, terms of moneyness. So let's look at that with respect to calls. Those three terms are in the money, at the money, and out of the money. The way I describe this is, think about it from the option holder's perspective. If the holder has the right to execute a transaction in shares at a better price than is being offered in the open market, then the option is in the money. Remember what it means to buy calls. You have the right to buy shares of stock. If the current price is 50 and we have the right to buy shares at a better level than 50, which means lower, then the option is in the money. And then you can further calculate how much is it in the money. The 40 strike option is $10 in the money. The 45 strike option is $5 in the money. The opposite is true for out of the money options. The call holder has the right to purchase shares at a worse price than where the share price is currently being offered in the open market. And at the money is more or less where these two numbers are equivalent. By definition, it is where they are equivalent. In practice, at the money options are those very close strike prices to where the stock is currently trading. For puts, same three terms: in the money, at the money, and out of the money. But again, we've got to flip it in our minds, look at it from the opposite direction, thinking of it from the put holder's perspective. Put holders own the right to sell stock. If they own the right to sell shares at a better price than 50, that's going to be higher. Better price than 50 is the higher numbers. It's an in the money option. And then we can further calculate how much is the $60 put in the money. If the stock's at 50, it's $10 in the money. This is 55 strike is $5 in the money. And by the same definition, a put is out of the money if the put holder owns the right to execute shares at a worse price, sell stock at a worse price than they could sell shares in the open market. These are your lower strike puts from where the stock is currently trading. At the money is when those two levels more or less equal each other. So now let's look at option premium. I'm going to break down the variables and components in just a second, but I often get asked, where do option prices come from? Who makes options prices? And while there are certainly professionals who are displaying their bids and offers, there are pricing models that can help guide what the values of the options should be. The prices really come from everybody. That's institutional investors, that's individuals, you, me, everybody else, professionals, whoever is putting it in a bid and offer into the market is driving where options prices are going. Ultimately, an option is worth wherever supply and demand show that they should be worth. So when there's more demand, option prices go up, and when there's more supply or more sellers, option prices go down. This is just the way stock prices work. More demand, prices go up. More sellers, option prices come down. It works the same way. Now we're going to break out an options price into its components. In its most simple form, an option premium can be broken up into two pieces. One is the intrinsic value. An option only will have intrinsic value if it is in the money. Remember, we just defined what in the money is. So only for in the money options, there's intrinsic value. At the money options, out of the money options, they have zero intrinsic value. For in the money options, there will be intrinsic value calculated by simple arithmetic. What's the difference between the strike price and the stock price? You can determine intrinsic value in a matter of seconds anytime you look at an option. If it's out of the money, you know it's zero. If it's at the money, you know it's zero. If it's in the money, you know there is intrinsic value, and then it's the simple arithmetic, taking the difference between these two prices. The rest of an option's value is considered time value, otherwise known as extrinsic value. Time value has a number of different pieces that affect it. Remember, this is the value of a contract that accounts for what's going to happen in the future. Between today and expiration date, what might the stock do? What are interest rates? What dividends might it pay? What kind of volatility might there be in the stock between today and expiration date? That's an uncertainty. It's always changing. Every day there's a different assessment on how much volatility there might be. How many days are there left until expiration? That is constantly eroding. That's that natural erosion piece that I mentioned earlier. The option buyer is going to suffer from that natural erosion, but the option buyer might benefit from an increase in intrinsic value due to stock price movement. They also might benefit towards changes in the perception of future volatility of the stock price. That might go up. This is the big unknown, but when it's all said and done, these components here are going to be your inputs into the options pricing model if you were to use a calculator, as again, Richard pointed out in the beginning. But your option premium that you are going to calculate is going to be the result of inserting these variables. We know where the stock's trading. We can see it. We know what the strike price is. That's not going to change. We know how many days there are till expiration. We can look up risk-free interest rates. We can look up what dividends are going to be paid. We have to have a volatility assumption. Either we have one, we insert it and calculate our value, or here's the tricky part. Sometimes you observe the option value, and instead of calculating the value, you insert it and back solve for volatility. That's often what investors are doing who are trying to evaluate. Is volatility high? Is volatility low? They are inserting the observed option premium, back solving for volatility, and then evaluating it from there. Remember I said supply and demand is what drives this price? So if option prices are going up, all else equal, if option prices are going up, then volatility is going up along with it. If prices are going down, then volatility is going down with it. And I say that because volatility is not some mysterious thing. When you hear implied volatility, that's the specific term that this is referring to with respect to options. Implied volatility in the future is going higher. If you hear that, investors tend to not quite understand that. All that means is there are more buyers for the options and the price of options is going up. That's all it means. It's all a function of supply and demand. But here's the option premium in its totality. Buyers of options know they're going to suffer. They're trying to profit mostly off of stock price movements. Sellers of options are trying to capture time value. They like this natural erosion. They hope volatility doesn't go the wrong way for them. And they're hoping that the stock price doesn't move against them to a significant extent that they experience losses. In its most simple form, this is options premium. Now, one quick segment before I do some questions. I want to walk through what you might see in your account, even if you're trading options, but particularly if you're new to options. If you buy, what would you see? What you notice in your account? You want to check your balances. And if you sell an option, what would you see? So let's look at first the buying example. We'll start with looking at a September 90 strike call option quoted $1.20 at $1.30. That's the bid, that's the offer. And you decide you're just going to go ahead and buy one of these call options at the offer price of $1.30. If you do that, you're going to pay the premium of $130. That's cash debit out of your account. And now you own a position. You have this call option that has value. Your account statement is going to value it somehow. Most often, firms will value the option at the best price you can close the position at. If you own the option and you paid $130 and you had to sell it right now, the best price you can get is $1.20. That's the best bid. And often firms will value the position you hold with that quantity. So in this case, remember this is $130. This is going to be $120. So immediately, you would expect, it's normal to have this slight drawdown in your account balance just being a function of this bid-ask spread. And this is one contract. If you bought 5 or 10 or 20, then you might see your account balance dropped. And that's just because of the bid-ask spread. It's just the way it works. And the value is going to change over time. So you have a market rally. Market moves in our favor. And now the value of the call has gone up. It's $350 bid, offered at $370. The cash is still $130. That's still our expense. That didn't change. But now the value of the position we have has gone up to the best bid price of $3.50. And our account balance is moving along with it. And we'll have an unrealized profit of $220. Your account balance will be greater by $220, but it's unrealized gains. So now the third piece, the market starts to weaken a bit. And you think, all right, I'm done with this trade. I get out. sell to close the option for $3. That's 300 total dollars. You receive 300. So your net cash is up $170 now between the two, the purchase and then the sale, net 170. The position is gone. And now your account balance will have its fixed realized profit of $170. This works just the way it does with buying and selling shares of stock. You have a cash outlay, you have a position that has value. The one difference here is on our next example. Investors are often not selling options. So we'll just look at that so you're comfortable with seeing that. Selling calls and selling puts for various reasons, even for conservative investors, selling calls and puts, if done the right way and done responsibly, is a very popular strategy. So let's look at that. June, we'll say 35 strike put option, 275 bid offered at 285. We think the stock is going to sit around here, maybe drift lower. We want the shares. So we're going to sell an options contract. We sell one June 35 put, taking in $275 for that sale. Now we have a short position in our account. We're short one June 35 strike put option. Similar to the previous example, the your firm is likely going to value this put at the best price it would cost you to exit the position. If we sold it at 275 and we had to buy it back right now, the best price available to us on the open market is 285. So this will be a debit. Remember, we're short, so we would have to pay this amount to close it. This position will be a debit of $285, resulting in that slight overall drawdown in the account balance upon execution. This is common. It doesn't happen every time. It depends on how wide the bid-ask spread is and how good your execution price is. But this is common to see, and I don't want anyone to be spooked if they do start trading options and all of a sudden, within seconds, they see their account balance is lower. It's really just this functionality of bid offer, bid-ask spread. So now some time passes. 3 weeks go by. The market for the June 35 put, 155 bid, 165 offer. Our cash is still sitting there in our account. That's ours to keep, 275. Now the debit position has decreased because the value of the option has decreased. It's gone in our favor. So now the position is a debit of $165, and we're sitting on an unrealized gain of $110 in our account. Further step, June options expire and the 35 put is worthless. The stock stayed above 35. We made money on our put option. The cash never changed from its onset. We didn't have to buy anything back, so we're still up 275 there. The position goes away, and our overall account balance will have gradually drifted higher to reach this profit of 275. I often ask the question, when you sell an option and it expires worthless, when will you see your account balance change? When do you see that increased value? And I think a knee-jerk response for options investors is to say, well, you see that right away. You see that gain right away because you're paid up front. Well, just take a step back and think about it. You're paid the cash up front, but you have a debit position in your account. If it does expire worthless, your overall account balance will gradually increase over time to reach a level that equates to the value you sold the option for. So we'll take some questions now. I hope you found that useful. And as I do, I will throw up our contact information if you want more education from us. We offer free education. We don't sell anything. So come check out the website and contact our investor services team at options@theocc.com. So let's see, we've got a number of questions here. So thank you for sending those in. We have a question about a put spread. If the equity is trading at 230, would you buy a 235 put and sell a 220 put? Or would you buy a 225 put and sell a 220 put? Okay, good question. Whenever you're evaluating two different choices, I can do this or I can do this, there's generally not going to be one that's superior to the other. There's advantages and disadvantages of both. If you did the 235, bought the 235 put, speculating, say, on a downside move, but reducing your cost by selling a 220 put, and I'll look at the put speculating example to do this. Instead of buying the put option and paying a certain amount, this question is, well, why don't I sell another option down here and bring in some premium? And if you do that, you change the risk profile a bit. If you choose the wider spread, you're paying more money. Your break-even point will be higher. You'll have more profit potential. It's actually just extending the risk reward of the position. If you do the more narrow spread, reaching down further to the 225, 220, your cost is going to be far less than it would be if you did the 235 strike, but you're going to need a bigger move in the stock price. You would actually also expect, should you maximize your gain there, that 235, 220 is going to have a very high dollar amount gain, but the 225, 220 spread, that more narrow one, would probably have the greater percentage gain. So it's a tale of two stories. What is your perspective? How aggressive do you want to be? And what is your risk tolerance? Can you please explain the Greeks, in particular, the significance of implied volatility? I touched on that a bit. Implied volatility is that unknown element within options pricing that the market is always trying to figure out. What's the future volatility of the stock going to be? And that's what implied volatility is. In contrast to what's known as historical volatility, looking back at what the stock's done, well, options might care about that, but we're more concerned about what's going to happen between today and expiration day. That's what implied volatility is. It's constantly changing, but in the most simple explanation I can give for it, it changes based on supply and demand. Are there more buyers coming in for options? If so, implied volatility is going up. And if there's more sellers, implied vol comes down. There are traders who will evaluate that number and make a trading decision off of their opinion on what they think that implied vol number should be. Another question about put spread, call spread. Sure. So, again, just to outline, we just did the put spread here, call spread. If we were to change the example I gave earlier, say buying a call, speculating the upside, buying a 140 call, paying 360. One way to offset that cost would be to say sell a call option at the 145 strike. Receive premium for that. You'd pay less than 360. What it does then is it reduces your cost, but it also would take away your further upside profit potential. If you did sell the 145 call, then what you're going to end up doing is you'll change the way this risk profile looks. And instead of having your profit potential continue to the upside, I don't know if this makes sense here, but your gains would be capped at 145. You'd have the right to buy shares at 140 and the obligation to sell them at 145. And instead of having this potential further gain, you would capitalize or maximize your potential profit on the trade. If you are selling a call, is that a 1-for-1? I believe this is referring to the covered call strategy, I think. So with covered calls, are you doing this 1-for-1, 100 shares to one option? The classic definition of covered call would say, yes, that is what you're doing. If you own 500 shares, you'd sell 5. If you own 1,000 shares, you'd sell 10. But if you get into this conversation, I can have a whole presentation on this alone. You will see the flexibility of options. If you have 1,000 shares of stock, you can sell as many calls as you want. You can sell 8, 5, 10, 1. You can choose different strike prices, sell 5 at the 80 level, sell 3 at the 85 level, sell 2 at the 90 level. You can choose different strike prices and different expiration dates and stagger. That's what's known as sort of staggering up your strikes or staggering out your expiration dates. All sorts of things you can do if you are long a multitude of shares. Also selling fewer calls. If you don't like this aspect of covered calls where you're maximizing your potential gain, you can sell fewer calls than shares owned and own some stock. Should there be a big rally, you would have some stock that could be profitable. If you buy a call and it reaches the expiration and you are up, say, I presume profitable, will it sell on its own? Do I have to sell it? You will have to sell it. It will likely not sell on its own. I like this question because it is something you have to pay attention to. Options are not set it and forget it type of trades. As we look back to the call buying example, if you did nothing, you're up money on this transaction, You're profitable. If you just did nothing on it, the stock's at 145, then your firm might actually exercise this on your behalf because it has value and they don't want it to expire worthless. So they might exercise it on your behalf and put you in a long stock position. And you probably don't want long stock because that's why you traded option in the first place. So if you want to avoid having long stock or getting into trouble with your brokerage firm, and you own a call option that is profitable, you would need to sell it, execute a sell to close prior to expiration. And then there's more questions on this. Can you execute your contract prior to expiration? Well, yeah, I believe this means exercise prior to expiration. You certainly can exercise prior to expiration. It is often not in your best interest to do so. If you exercise the call early, you're paying money for the shares before you have to. You can just hold the call option if you wanted to continue the position. If you wanted to exit the position, you don't need to buy stock at all. You can just sell the call, be done with it. If you want to continue with your bullish outlook, again, prior to expiration, you don't need to exercise early and buy shares to do that. The call option is going to perform for you. Same thing with put. Now, the only exception I'll point out with respect to calls, and just put this in your mind, is with respect to dividends. If you have a dividend payment that is upcoming, then you might want to think about exercising your call specifically the day before the ex-dividend date, and only if the option is in the money. That is the circumstances under which you might consider it. Let's take one more. You called yourself a market maker. What's a market maker? Okay, I'll finish with this one, and then I'll stick around and answer these questions. I'll type in some answers for the folks that are sending them in. I appreciate that. Market makers are professionals who are trying to make money off of providing liquidity to the market. If you're an investor or a market participant, money manager, bank, and you want to execute a trade, someone needs to take the other side of that trade. When I was a market maker specifically, I was doing open outcry in the trading pits, and an order would come into the trading pit who wanted to trade a call or put option. I provided them a bid and an offer, provided liquidity to that market participant. That's what a market maker does. And that's what I did for a number of years. And I was not directionally biased. I didn't care if the market went up or down. I didn't care if volatility went up or down. I was trying to be as neutral as possible, buying and selling options all day long, capturing the best bid-ask spread that I could and eliminating all of my risks. Simplest way I can explain it, a liquidity provider to the market. And again, lots of more questions here. I'll stick around, answer those. And I appreciate all the feedback. I hope everyone found the session to be useful, and I hope you enjoy the rest of the day and welcome our next speaker.